Hi, I'm Andy Temte, and welcome to the Saturday Morning Muse. Start your weekend with lessons that are designed to improve financial literacy around the world. Today is November the 8th, 2025. Last week, we discovered how railroads brought stock ownership to America's middle class in the 1800s and transformed the market into a measurable barometer of economic health. Tens of thousands of ordinary Americans, doctors, shopkeepers, teachers, now owned shares in the companies that were building the nation's infrastructure. But this democratization created a serious problem. How could an investor in Chicago know what price their railroad shares were trading at in New York? How could a broker in Boston execute orders for clients without traveling to Wall Street? The railroad boom had created a national market for stocks, but information still moved at the speed of horses. Today, we're exploring how information technology, even primitive 19th century technology, transformed equity markets more profoundly than any financial innovation we've discussed thus far. So, picture yourself as a railroad investor in Cincinnati in 1850. You own shares in the Baltimore and Ohio Railroad, but those shares trade on the New York Stock Exchange nearly 700 miles away. If you want to know today's price, you have two options. Wait several days for a letter from your New York broker or travel to New York yourself. This information delay created real costs. By the time you learned that your railroad's shares had dropped significantly due to an accident or management scandal, the opportunity to sell at a better price had long passed. Conversely, good news about new routes or profitable results reached distant investors too late for them to benefit from price increases. Even worse, this information asymmetry gave enormous advantages to those who were physically near stock exchanges. A broker on Wall Street could execute trades based on breaking news, while investors everywhere else remained ignorant for days and sometimes weeks. The solution arrived in the 1840s with Samuel Morse's Telegraph. Yes, we're going to talk about Morse code today. By 1844, Morse had demonstrated that messages could be transmitted instantaneously across wires using his ingenious code of dots and dashes. Within a decade, telegraph lines connected America's major cities. By 1861, the transcontinental telegraph linked the east and west coasts. Suddenly, information that once took weeks to travel could arrive in minutes. For stock markets, the telegraph was revolutionary. Brokers in distant cities could receive price quotes from New York almost instantaneously. An investor in San Francisco could send buy or sell orders to Wall Street and receive confirmation that same day. Regional stock exchanges like Philadelphia, Boston, and Chicago could now operate with current price information rather than outdated data. The telegraph fundamentally altered the nature of stock trading. For the first time, securities markets became truly national rather than local or regional. Prices in different cities converged as arbitrage opportunities, which are buying low in one location and selling high in another, became much harder to exploit when information traveled in minutes rather than days or weeks. We'll explore arbitrage in much more detail in future episodes, but for now, understand that arbitrage serves as a crucial built-in market regulator that helps keep prices fair and efficient across different locations and through time. Now, in 1866, another information breakthrough arrived. The transatlantic telegraph cable came into existence. After multiple failed attempts, entrepreneur Cyrus Field successfully laid a working cable connecting North America and Europe. The impact on securities markets was immediate. London and New York, the world's two dominant financial centers both today and at the time, now could communicate in minutes rather than the 2 weeks it required for a ship to get across the ocean. British investors could learn about American railroad developments almost instantaneously, and American investors could figure out what was going on in Europe much, much faster. This created the first truly global securities market. A financial panic in London now rippled through New York within hours, and arbitrage opportunities between these key exchanges shrank dramatically as professional traders could exploit price differences much faster than before. And importantly, investment capital flowed across the Atlantic with unprecedented speed. Now money was seeking the highest returns regardless of geography. The world had gotten much smaller. The Telegraph solved long-distance communication, but brokers still faced a big problem. Telegraph operators had to manually transcribe messages and deliver them to recipients. During busy trading days, this created bottlenecks and delays. Well, in 1867, Edward Callahan invented the stock ticker, a specialized telegraph machine that automatically printed stock prices on thin paper tape. The genius of Callahan's invention was its simplicity. Instead of requiring trained telegraph operators to decode Morse code, the ticker printed company abbreviations and prices in plain text that anyone could read. Within months, hundreds of brokerage offices across New York had installed tickers. Brokers could now watch prices update continuously throughout the trading day, not just receive periodic telegraph summaries. The famous ticker tape became the heartbeat of Wall Street, constantly churning out the latest prices as trades executed on the exchange floor of the New York Stock Exchange. So that's where all of that ticker tape came, for all those ticker tape parades that you see in old movies. The ticker machine democratized information in ways that even Callahan might not have anticipated. Small brokers who couldn't afford dedicated telegraph operators could now access the same price information as major firms. Regional newspapers began publishing daily ticker summaries, letting ordinary investors track their investment holdings. The stock market became transparent in ways that were unimaginable just a few years earlier. Now, this information revolution wasn't entirely positive, as you might imagine. Faster information created new opportunities for manipulation and fraud. Unscrupulous traders could plant false rumors that spread instantaneously via telegraph, manipulating prices before the truth caught up with them. The practice of cornering the market or accumulating enough shares to artificially control prices became easier when traders could coordinate across multiple cities simultaneously. The telegraph also amplified speculation. Traders who cared more about short-term price movements than the company's fundamental or intrinsic value found their strategies far more viable when prices updated constantly rather than sporadically. When information flowed slowly, successful investing required patience and research. When prices updated by the second, speculation became viable as almost a full-time occupation for some. These concerns would later contribute to the regulatory reforms that we're going to explore in the following weeks, but they revealed an important truth. Information technology amplifies both legitimate investment practices and predatory speculation. Now, the Telegraph and the ticker tape machines established principles that govern markets today. Information should be widely distributed, not concentrated among elites. The second thing is that price transparency creates fairer, more efficient markets. Third, speed matters. Timely information provides significant advantages over delayed information. And finally, technology that democratizes access to data transforms who can successfully participate in investing. Now, these 19th century innovations laid the groundwork for everything that followed: electronic quote systems, real-time market data on websites, trading apps on your smartphone. The principle remains unchanged. Informed investors make better decisions, and technology that spreads information widely creates more efficient markets. Next week, we'll discover how this democratization of information, combined with easy credit and excessive speculation, created conditions for the most devastating market crash in American history. The same technologies that made markets more accessible also made them more volatile, setting the stage for reforms that would define modern securities regulation. So, until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is the Saturday Morning Muse. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public good with your friends, your colleagues, your neighbors, and maybe a family member or two. The show is produced by Nicholas Temte, and we'll see you next time on the Saturday Morning Muse.